Hey, good morning, traders and investors, and welcome back to our Wednesday live stream show. I'm Bennett Tyndall, tradinganalysis.com. Hey, thank you guys for taking time out of your Wednesday morning to join us. We greatly appreciate it. Can't believe we are now a week away, just about a week away from the Thanksgiving holiday. Markets will be closed next Thursday. Next Friday, look for the early close. I think it's 2 p.m. Eastern. So hey, yesterday we had a very strong retail sales report actually coming out as both Walmart and Home Depot came out with the top and bottom line beat. So the consumer demand continues to remain strong. Some very interesting metrics actually on the Home Depot side. There are still some somewhat mixed signs out there as last week's CPI numbers did spark a breakdown in bonds, a breakout to the upside in yields that we were looking for. Simultaneously, we've seen the break-even inflation rates continue to move on the upside after kind of back testing the May area resistance. In addition to that, we've also seen some interesting moves out of rate hike probabilities into next year, but this market just continues to climb the wall of worry and remains very relentless. And at this point, you know, even with those potential signs, if you caught my recent public market update, you'll know that, you know, end of Q1, maybe mid Q2 of next year, I do see the possibility on the charts for a larger correction, but that market correction might not even visit current levels. So would I use that as a reason to attempt to sidestep or remain sidelined in cash until that happens? Absolutely not. This market has navigated pretty much every headwind that has come its direction. So we're going to continue to keep our eyes on the hard right edge of the chart and continue to press the long side with our clients. Let's go ahead and bring in the trading analysis team before we take you into the charts. Good morning, Terry, and good morning, Alex. How are you guys doing, gentlemen?
Good morning, Bennett. Good morning, Alex. Good morning, traders.
What's
Hey,
happening,
good morning.
boys? What's up, Alex? How you been, man?
Well, all good on this side. Watching cryptos.
Yep.
Some reversals still not confirmed, but things starts to shake up there with yesterday's infrastructure bill with the taxation on cryptos and China going again over the miners issue, and yet again issuing warning to companies which are mining to back off. So yeah, interesting stuff. We will go over some charts a bit later.
When I moved to Texas, I considered starting some crypto mining. The cost of electricity here is at least so much cheaper than I paid in California that it was tempting. It was tempting. So, well, hey, glad to have you guys joining us this morning. As always, we appreciate it. Let's jump in. Any opening thoughts before we dive into the markets? Futures are pretty quiet this morning. Last week when we met, we looked at the possibility of a bit of a wave 4 corrective pullback. After we met last Wednesday morning, we actually saw that fourth wave unfold during the Wednesday market session, find some support, and we've seen it move back. We've seen it move back here that we want to talk about and look for the seasonal continuation into the Thanksgiving holiday. So anything else you guys can think of that's pressing? You know, last week, speaking of last week's CPI numbers, sorry, I didn't mean to interrupt you, Terry. And Alex is going to look at this in just a second, but in gold, when the CPI number print hit last week, we saw a fairly, you know, defensive-looking rally in gold that took you up to some key resistance levels. That has since backed off, and we continue to view that as likely premature. Alex will take you down and look at that. What do you guys think? Alex, Terry, any thoughts on that gold move?
We will. Let's wait till Alex throws his chart up there. But certainly looks like we've been calling for a triangle formation that I think is clearly unfolding. And I think yesterday's move looks like it might be confirming that. But again, we lay out the plans and we have our options and our alternatives. And I know everybody's eager to jump right in to buying gold and or the gold miners, but I still say be a little bit careful getting in right now. I'll leave it to Alex to cover that in more detail.
All right, very good, much appreciated. Gentlemen, I'll be back. I'm going to take them into the hard right edge of the Motive Wave platform. Take a look at the indexes, and we'll be back, take you into sector focus to follow. Catch you guys in just a second. All right, good morning once again, and thank you guys for joining us. Let's jump into it. Hard right edge of the Motive Wave platform. One of two key tools that we utilize in addition to Optima. Of course, Terry will take you through Optima in just a few minutes. All right, so here we are. We're taking a look at the S&P 500, and we've taken the opportunity to jump right down to the 195-minute half-day time frame. The corrective pullback that we saw into October, it was kind of funny that despite all the subjectiveness of the index, at least the S&P and the NASDAQ wave count from the COVID low, every three-wave move to the downside has been fairly typical of a counter-trend corrective pullback, and they've continued to resolve into new highs. So this market is very relentless, continues to climb the wall of worry, and we see no reason to go against it until we see that collective underlying shift in sentiment. So here we are, 195-minute half-day chart, upper left-hand corner or mid-left-hand corner of your screen. We've got our September area high. September high in the S&P 500 delivered a three-wave move into the October 4th low. We have a move up in 1 and down in 2, and you might be looking at that and saying, my goodness, Bennett's labeling a motive wave that's a three-wave subdivision? Absolutely not. We've been over this, so I'm not going to take a whole lot of time, but long story short, we continue to see the most appropriate labeling and decomposition of price action between October 15th and 13th to be an Elliott Wave flat. However, when doing so, our fib levels are a bit skewed. So we feel it's a bit more appropriate to utilize the entirety of the October 4th through October 7th breakout to the upside for our third wave fib projections. So on the 195-minute chart from the October 13th low, which is the day we had the previous month's Fed meeting minutes and had some clarity shed on the tapering topic. Markets liked it, and we ran right into a new high. Orange Wave 3 did find resistance just shy of its 2618 projection of Wave 1. From the 195-minute chart, I'll take you to the 1-hour time frame, and we're going to focus in on all of the price action that's occurred from November 5th into today. In fact, we'll go all the way to the 15-minute time frame. Looking at the 15-minute chart in the S&P, we can count what is viewed and can be labeled as a three-wave decline. You'll notice the guideline of equality that suggests corrections of the same degree do tend towards equality in either magnitude or duration was exhibited. In fact, equality in time would have been November 11th at 9:41. The low was November 10th at 1:48. We were just a stone throw away from equality in terms of percent correction in Wave 2 compared to 4. And from that November 10th low, which was last Wednesday, we have since now moved up in another 5-wave rally. This 5-wave rally, we're going to be looking to get very aggressive on any Wave 2 retracement that exceeds the child wave magnitude. That will satisfy the requirement to be a Wave 2 of this higher degree Orange Wave 5. And this should set us up for continuation into next week. Now, there is a very small chance that, in fact, we're still contained within this orange fourth wave, and all of the price action that we've seen since the November 10th low is actually just a B wave. If this is the case, there is the possibility that we do break south of the November 10th low. This is a back of the pocket alternate just to have context in the event that we don't defend the support zone that we're currently looking for. So, fairly sizable move. We have a confluence of trend exhibited on many of the sector wave counts. So many of the sectors that make up the broader index are supporting the idea that we're moving higher in some sort of a Wave 5 position. This is the S&P. Let's go ahead and take a look at the NASDAQ 100. Here in the NASDAQ 100, we've seen a very similar trend unfold from our October 4th area low. Speaking of guidelines, you can see the guideline of corrective trends meeting equality being exhibited here into the October 4th low. We have a move up in 1, down in 2. The same thing can be said here. We feel the most appropriate way to label it is a flat, but we also feel it's more appropriate to use the entirety of the October 4th through 7th rally for our fib projections. The pullback into November 10th was just beyond equal to Wave 2, and we've since seen an upside breakout. Now let me take you over here to our blue count as I have it already decomposed, but you'll notice here in the NASDAQ, we've also seen a motive trend print from the November 10 low. So we continue to remain bullish, looking for that seasonal continuation into the end of the month. Let's go ahead and take a look at the Russell 2000. One of the things that we saw recently that was constructive to overall market breadth was the idea that the trend was broadening. No longer was it riding on and resting on many of the index heavyweights and the FANG names, but we saw a decent breakout in both small and mid caps. The chart of the Russell 2000, as you know, we've been watching going back to the July low, looking at that as a wave 4 correction. We were in a 8+ month sideways consolidation channel. From the daily chart, I'll take you down to the 1 hour time frame. You can see here on the 1 hour chart from July 19th, up in 1, sideways flat in 2, leading diagonal up in 1, down in 2, up in green minor wave 3. Within green minor degree wave 3, you have a very solid 5-wave trend. And notice here in the Russell 2000, on the 1 hour chart, from the high from November 13th or November 8th into November 10th, that's a 3-wave move. That goes back to the conversation we had earlier in the year, continuing to look at the basic concepts of Elliott. 3-wave corrective trends, 5-wave trend establishing moves. So the 3-wave decline that we saw into November 10th, we view as corrective. We're 3 waves back up, 3 waves back down. This puts us in probably just a wave 4 triangle in small caps, looking for a breakout into the end of this month and possibly early December. So that's what I have for you guys today. If you're interested in more analysis specifically on 10-year yields, Alex will be in to take a look at that in just a minute. I did take you through that in my recent public video update. One of the other charts that we're watching with our clients and looking to get aggressive in towards year end is the chart of Apple. And looking at Apple, we're going to take you right to a 1 hour time frame. And what we're looking at here in Apple, from its September 7th area high into the October 4th area low, is the idea that Apple is also trading in a 4th wave position. This 4th wave correction in Apple pairs up beautifully with the S&P and the NASDAQ, and this increases our conviction level for getting aggressive into wave 5. If the indexes go, chances are so will Apple. Looking at this trend from October 4th, we have a leading diagonal up in 1, a very sharp 3-wave retracement in 2, 5 smaller waves in blue wave 3. Blue wave 3 did meet its 200% projection of 1. We also see a 78.6% Fibonacci retracement of the September 7th through October 4th decline, acting as resistance. The fact that that 786 retracement resistance has since yielded sideways contracting consolidation, this is textbook 4th wave triangulation. You might be thinking, well, gosh, I thought wave 4 was done in the S&P and we were already moving higher in wave 5. That's true, and I can show you this chart here in the S&P that says, hey, look, we just did 5 waves up. We're going to get a corrective retracement in 2. So what that looks like in Apple, for those of you new to Elliott, that simply gives Apple the opportunity to conclude E of triangle 4, then break higher in 5. It's just as valid to say, you know what, wave 4 concluded here, and this is wave 1 and wave 2 of 5 as well in Apple, but with the idea that we're going to correct potentially into the end of the week and then rally into next, I wouldn't expect a child wave 2 to be of this to be of this duration in a higher degree 5th. So I think it's much more appropriate to view it as a triangle. And in fact, if you look at some of the traditional technical indicators, it fits triangulation really well. So those are some charts we're watching. That's kind of our outlook into year's end. We're, of course, going to continue to watch the upside move in the dollar, continue to watch yields. Crude oil, as you know, has been moving higher. We met our upside targets in crude. Check out the public update there for more information. Tesla, Alex, Tesla's an interesting one. Here, I'll give you a quick rundown on Tesla. Looking at Tesla, going back to the January 21 high, this first big 5-wave decline that we had into March, we pegged the April 14th B-wave rejection, looking for that C-wave continuation. I was a little bit frustrated with the fact that the C wave ultimately truncated and came about 50 points shy of our major downside support zone. That's fine. That just shows the underlying strength here in Tesla. The fact that we did find support before backtesting those levels. It would have been nice to really have kind of gotten down here and see to confirm support back off the August 31st area high. But since that C wave completion, we've got to move up in 1, down in 2, a massive rally in wave 3. Wave 3 was 200%, beyond 200% of 1, not quite a 2618. And the trend that we've seen off of the top has been pretty aggressive, as you know, Elon Musk selling some shares there. The bounce has been at the 38% retracement of Blue Wave 3. There is the possibility that that Blue Wave 4 actually concluded at a 61.8% time projection of 2 and right into the 38.2% fib level. Those line up perfectly. The only thing that I would say about that possibility is, you know, down on the smaller time frame here, it would call for a fairly shallow C wave compared to A, but there are some characteristics that were exhibited in this B wave that were very similar to this B wave here. Blue B back here, or I should say green B, is like a you know, minuscule fractal of this bigger B. If you get down into it, it's really quite fascinating. So this is one we're going to continue to watch. I tell you what, if Tesla's going to go again in wave 5, I want to be involved in trading that name. So we'll leave it at that. We'll jump back over and bring in the trading analysis team. Terry,
Yeah,
Alex, what do you guys think?
I love that Apple analysis there with the triangle formation, because if you were to look at the XLK or the NDX, I think you're going to be following that pattern. It makes the most sense. So I like it.
Yeah, I'm excited about that Apple move. It could get very interesting. All right, let's jump into it. Mr. Terry Long, you ready to bring us up to speed on the world of sector rotation?
All right, let's go.
All right, here we go.
Hello, traders. I'm Terry Long at tradinganalysis.com with your weekly sector focus. So, after setting new all-time highs last week, the markets decided to take a little bit of a brief pause. Now, last week, the materials sector soared over 2.6%, and it was actually the only sector not seen in a corrective pattern. Also on the week up were healthcare, industrials, financials, and technology. But their gains were a little bit more modest in comparison to the materials sector. Now, Tesla's rapid reversal and decline mirrored its prior week's rapid gains and actually dragged down the consumer discretionary sector, making it the worst performing sector last week. And the energy sector also saw some declines, as it's really been consolidating sideways to lower after it had a big rally. Now, coming off of those all-time highs, we've seen the S&P last week declined 0.31%, and the NDX was down just about 1% on the week. Now, trading has been relatively quiet so far this week. Now, Monday saw the S&P close essentially flat, zero gains, similar indecision in the NDX, but Tuesday saw the consumer discretionary, the energy sector, and consumer discretionary, energy sector, and technology sectors resuming an uptrend. Now, the S&P is positive 0.39% so far this week. NDX is up 0.68. The communications and materials sectors are somewhat lower this week, so kind of wishy-washy there with consumer discretionary. Probably more Tesla pressure happening as we see, but like I said, 1.49%, it's not too bad for a nice gain this week. Now, on the downside, materials and staples and Sorry, this is communications, what I keep saying. Yeah, communication sector. Okay, so this past week, the consumer discretionary overtook the technology sector for first place in our relative strength ratios. So, but you can see here that energy and financials are still grouped with the consumer discretionary. These are our sector leaders. All the other sectors are currently in an underperforming condition with respect to relative strength as compared to the benchmark S&P. Now, real estate, healthcare, communications, staples, and utilities sectors, they continue to see further declines in their relative strength ratios. You see the vectors moving to the left, and that means they're losing relative strength. But I want you to take a close look here at the industrials and materials sectors. Now, these two beaten down sectors have now formed new hooks back to the northeast, and they are starting to move back up here into the improving quadrant. Now, this is our first clue that these sectors may be looking for more relative strength gains in the upcoming weeks. So we're going to monitor these two sectors closely to see if we can identify stocks within those sectors that are forming constructive patterns and setting themselves up to become the next set of market leaders. Now, I've done some proprietary scans already here in Optima, and let's take a look at what I'm seeing here. So these blue vectors indicate that we have a weekly improving price trend going on in these stocks. This is the materials sector. I've screened out about 6 stocks here for your selection. We've got Vulcan Materials, Sealed Air, Martin Marietta, International Flavors, Freeport McMoran, and Corteva. And this is where there are rotations. Now, not advocating buying in at these price levels, but you should add these to your watch list and identifying entry points that are conducive to your own risk-reward plans on any significant pullbacks. And I also have a similar list here for the industrials. I've got 8 stocks listed here. You can see there's their vector rotation as I bring it in. You can see some of them have started earlier on, but now they've all got these blue improving trends, very fast moving vectors up here into the improving quadrant. These guys are going to be your next set of market leaders. So if you're looking to rebalance your portfolios, perhaps you've got some industrial or material stocks that are lagging, you want to find something to replace them with some leadership, take a look at this group right here. That's it for now, traders. I'll see you guys in the member Discord and the Wednesday webinar if you're a client. If you're not, why not? Sign up now, tradinganalysis.com/subscriptions. We'd love to have you as a member. You can enjoy a lot more detailed content that we provide each week to our members in the webinar. Thanks, Bennett. Back to you.
Much appreciated, Terry. Excellent work as always. Thank you for taking us through the Optima platform, taking a look at the rotation. Some interesting names there in the XLB and XLI. We need to keep our eyes on those for sure. All right, Alex, I'm going to go ahead and
definitely
pass.
Some rotation happening.
Yeah, most definitely. Most definitely. All right, Alex, sir, ready to bring us up to speed on the world of crypto and macro. Of course, if you're interested in more crypto-specific coverage, we do have a Crypto Lab live stream tomorrow morning, 9 a.m. right here on the Trading Analysis YouTube.
Yeah, Bennett, let's go.
All right, here we go, jumping into it.
Hey guys, let's look a little bit of a macro, then we're going to look some metals and crypto market. So let's start with the 10-year yield. We have been working over this chart for the last couple of months, and for now, this outlook is developing nicely. As we talked last time, this support around 1.44 held pretty nicely, and we are seeing a move up. We are trading now at 1.64. The next resistance levels is around 1.73. But if we take the basic Elliott Wave sequence in a 5-wave move, most likely we will touch this 1.88 and we will challenge most likely 2% in the next couple of weeks. So this wave count for now presents this huge move up from the beginning of the COVID crisis in 2020 as a wave A, 3 waves down in B, and then a 5-wave move development in a wave C, what we call the measured move. And the quality of this leg and this leg on the upside comes around 2.016. So I'm very interested to see what the rates are going to do at that levels. If we see these levels break on the upside, I'm afraid we will have to change this wave count in a more impulsive manner with the next target around 3.3, which is up there. As you can see, if I squeeze this chart, there is a next resistance levels. But let's go one wave at a time. If we see some move down in 5 waves, most likely this will be some type of a W, move down in X and then Y. So we might spend a year or year and a half in advance in this more inflationary environment. And also Fed on the last meeting, so just for the reference, the next Fed meeting is on 15th of December, so very soon. We have less than a month. So it will be a new, let's say, turnaround in a Fed outlook, especially I think if we get the next NFP numbers pretty solid. The last one was very solid. The jobless rates fell down to 4.7%. So the unemployment is falling lower, and the Fed was specific. They want to focus on the unemployment rate more than inflation. The word transitory kind of expanded in the Fed language into more stretched couple of year or two, maybe a time frame. They are arguably admitting that the first outlook that it's going to be a pretty short-sighted transitory failed, and now they're stretching this term to be kind of more adaptable for the next, let's say 2020, even 2022, 2023 outlook. So as Bennett mentioned, the rates outlook is climbing. The market is starting to price in a rate hike in 2022, and I think that is already at 20% in the first couple of months of 2022. So switching for the situation in Europe, pretty much sideways price action. This is the chart of the 10-year Bund in Germany. So this is the price. I just take this chart because the wave count is a little bit more visible than in yields. But the same chart, as the price goes up, yields are going down and vice versa. So this chart also, I'm looking as a, let's say, a sideways consolidation in a more potentially complex correction lasting another year. And from there, I think that these higher deflationary forces, when economy at least somehow stabilizes itself on this supply side, and of course, more people, when these benefits kind of wear out in the United States, seek for a job, that might also spur inflation up for a little bit, but then I think deflationary technology and also demographics will kick in, because there are a secular trend of the deflationary pressures which are lasting for the last 20-30 years, and I think this is going to continue. So I think this is just a cyclical inflation, and we will have a little bit more of that. But on the end, looking also this chart, I think we're going to finish still deflationary kick in and going further on the upside. As the dollar is concerned, we are moving strongly up in the dollar. There is a couple of scenarios here. We have been looking for this move, as you know, in the last couple of weeks on this live show. And actually this outlook now materialized. So equality is reached. So we talk about two levels for the dollar index. First one from this low, and we count this as a 5-wave move with a small truncation in the 5th wave. Very minor truncation, which is normal when you have a 15% move in one currency lower, which we have seen on the US dollar from beginning of the 2020, namely March, or COVID crisis. So this is the dollar index. And we have seen from this low 5 waves up, pullback in a B wave, and then now we can count this as a 1, 2, 3, 4, and 5, and we are completing here. But looking at the rates currently trading, and definitely dollar is moving also with rates on the upside. So as the rate outlook is moving up, also the dollar is moving with it because, of course, of the interest rate differential. I am proposing possibly that we might even start to go beyond this equality. We are waiting to see reaction and actually test this 1618, which is a rarer relation between A and C, but it might appear, especially in the dollar and in the current macro environment. So most likely I will stay with this, all of this to be a wave 1, pullback in a wave 2, and looking at the sharpness of this move, it has a character of the 3rd wave on the upside. So I will be looking more, most likely, if we even break these levels, this will continue on the upside. So I will look for 97, 98, small pullback, and then possibly in the beginning of January, that will prolong a little bit the dollar cycle. January, February, maybe we're going to reach 99, 100 on the dollar index, provided we penetrate this level substantially on the upside. So I would not like to see any 5-wave move down from here. That will mean that this was all of a dollar uprise, a measured move, and then we might look for a little bit of lower levels and even lower from the last lows. So I'm still not going to become very much bullish on dollar in this stage. Any cross of this 1618 further on the upside will make us change completely the dollar outlook. But for now, I would like to stay within this ABC move down to 80 in the next 2 years in the dollar. So my outlook on the dollar is a bit negative for 2022, 2023, and we are watching that scenario for now. So switching to metals, gold is still dancing with these possible highs in D wave. The RSI is pretty much trading around the last move on the downside, so this resistance level. So we have a little bit of pairing there. And if we go on a smaller time frame, let's say 3 hours, we can look this as a 5-wave move, maybe one more push on the upside. There is a wave 1 and 2, up in 3, 4, and 5. So we might challenge this 1880 and then start another ABC pullback to the downside to complete this E wave. And there, in that scenario, actually this triangle will be completed, kind of a pairing with this possibility that dollar has a little bit more upside. January, February, we have to prolong this E wave a little bit more if dollar starts to go towards 100 level, and that will actually pair itself pretty nicely, because usually dollar many times are inversely correlated with gold and with other commodities as well. So we are going to still keep this triangle wave count as long as some of these higher levels holds, especially this one at 1900 and this one at 1958. If we start to break these levels, we have a couple of more wave counts to show. But for now, I will keep this one because it works well. It worked nicely for the last couple of weeks, and I think we're going to see after a little bit more upside ABC pullback down back to this 1,756, from where a 5 waves up and a pullback would definitely seal the great probability that gold is going to continue up, trading around 2,200 or even above in this possible higher degree wave 3. So we're going to stay bullish in gold. This consolidation is definitely not a bearish sign. It is a sideways consolidation, which we still look as a pause in this gold trend, which started at end of 2016. And we are still looking for the upside prices in gold, most likely when this triangle is complete and we see the follow-up and confirmation in 5 waves on the upside. Silver is starting to get a little bit more traction here. So let me show you the silver. As Terry pointed out, we can squeeze some type of leading diagonal in a 5 waves up. So when the gold has a possible reversal in E wave, we might even see a silver just do a pullback. And maybe we might be brave and start to count this as a potentially first impulsive move up in silver. So if we subdivide this and actually put here a wave 1 a little bit more on the upside, and then look for some type of development in the higher degree wave 1, we can say that with this small invalidation, we can construct some type of a leading diagonal having here in a wave 1. And then a pullback from 26 down to 23, 22 will pair with this gold correction, and then they might actually start to move in synchronicity together on the upside if this wave count proves to be correct. So let's see. We have trading around this previous wave 4 on this diagonal. I still don't think that this is there is a small chance this is a kind of extended expanding diagonal as well, but let's wait a little bit more and see what the silver will do. Definitely 3-wave pullback will put silver further on the upside. Okay, so let's switch to cryptos. I want to show you this chart, which is the crypto market crypto total market cap. And yeah, this chart is very interesting because from a couple of reasons. We have a 5 waves up in one, pullback in a wave 2, and then we usually take this couple of fib ratios to measure the target for the wave 3. One of the most usual measures is 1618, which was surpassed a long time ago in this developing third wave. Then next one we have a 200 and 261.8, where we actually stopped. So we can also derive on the lesser degree 5-wave move on the upside, which also exactly stopped at that higher level. And when we also make extension on the smaller time frame, we get also a cluster of fib ratios from where we are reversing from. It's still not a 5-wave sequence, which will most likely give us a greater probability that this 4th wave is developing. But it definitely starts to look so. So I will be very careful. There has been many people calling some 100, 200, 150K towards the year end. And we are not seeing that. So looking all of these charts, we have been very vocal in our doubts that that will happen. So on the smaller time frame, we still don't see a 5-wave move, but definitely it looks like it's developing. So any 5-wave move from these levels, this Fibonacci cluster, will mean that we are going to see at least move down to 1.8 trillion. We are currently at 2.5. And even I think we might go even further lower from that. And that will definitely give us an opportunity to recognize what is going on in this 4th wave and be prepared for the big rise somewhere in the middle of the 2022 in cryptos. If you look couple of charts also in Bitcoin and Ethereum, they exactly look the same, which is normal. Bitcoin is struggling around this 60K, still offering some resistance to the downside, but the overall chart, if you look the higher time frame, pretty much looks the same. So as this crypto market cap, so 1, 2, up in 3, we are either in some bigger 4, or here we can see a wave 3 and a bigger pullback in a wave 4. So basically the same chart. And if you look the Ether, also pretty much looks the same. And we are seeing a move down, still not the 5 waves, but it looks it's developing potentially for this 4th wave pullback. So this is still not confirmed. I'm waiting very eagerly this confirmation so I can develop a potential path for this wave 4. But for now, I don't think that environment is so favorable. We have seen again warning from China yesterday, as I said. Also, the infrastructure bill, which included taxing cryptos, are now on the validation on a go side, so it's confirmed. So the environment it's not so good, but let's see. Let's wait confirmation. We're definitely going to talk much more about that in tomorrow's Crypto Lab, and of course we're going to see next Wednesday the latest development. So back to you, Bennett.
Sounds good. Much appreciated, Alex. Thank you as always. It's going to get interesting in the crypto market. If you guys are interested in staying up to date, of course, check out tomorrow morning's Crypto Lab, 9 a.m. right here on the Trading Analysis YouTube channel. And I would encourage you to test drive the crypto service. He does a fantastic job navigating the markets. So markets are open. Speaking of markets, S&P moving slightly lower from the completed 5-wave move that we discussed. Hey, if you did enjoy the content, please give it a thumbs up and subscribe with notifications. I was looking at last week's metrics. 40% of those, 40% of you guys who are tuning in are not subscribed, so we would certainly appreciate the support if you do enjoy it. So, team, Terry, Alex, excellent work. Members, we'll see you in about 25 minutes for the member webinar. Any final words of wisdom?
Well, watch it.
All right, sounds good. And Terry, much appreciated as always. We'll be back same time, same place next week. Thank you guys, and we'll talk to you then. Take care. Have a good one.